Kevin Green is here to take us through some levels we should be watching heading into the close. Hey, Kevin, how are you?
Marley, yeah, I mean, we've seen some pretty compressed activity actually happening in the S&P 500. A little bit of a boring day here, but when you're kind of looking at the options flow, especially on an intraday basis, we've seen about a 20-point range for the market here today. And we actually continue to see this range kind of being compressed going into the close here. So not sure if we're going to see a lot of fireworks, but if you're kind of looking at the upside resistance area that I'm focusing on, 59.90, there seems to be a significant amount of activity there on the call side. And then on the put side to the downside, looking at around 59.70. Now, if you kind of look at both of those levels, those have been pretty much the upper and lower bounds for today as well. But we are making technically lower highs as well as making higher lows. So hopefully we come to an apex here. We do see some form of action going into the close, but it doesn't seem like there's any aggressive buying or selling activity on the wings here for the SPX options that I'm seeing as of right now. So probably more compressed range, staying within those between those levels going into the close.
Yeah, pretty narrow trading range. As you look at the chart, because we've zoomed in so much, it looks like we've got some pretty solid movement, but only 20 points in there. As we take a step back, though, and we think about this longer term, what are you noticing?
Yeah, from a longer term standpoint, I mean, it makes sense that we have this area of resistance at around the 6,000 level. 59.70 was actually kind of that big, area or line in the sand if you're looking at it from a technical standpoint. But we're basically trying to base out and then break out to the upside, try to attempt all-time highs here. And we have several key areas of support that we continue to kind of monitor here. The 20-day moving average, which is going to be in blue, the 200-day moving average, and then as well as some trend lines that continue to hold up. And until we actually get a break of any of those particular levels, the bulls definitely obviously have the momentum in the market. Now, what you are seeing with the RSI, it is kind of breaking this little bearish divergence that did develop, but we are still seeing a lack of momentum when it comes to the price action, which once again, coming up to a key area of resistance is not outside of the norm. And we do have several levels to the downside that are still open gaps here. If you're kind of looking at the S&P 500, around that 5,800 level still has a potential gap to be filled, and then also down by that 57.35. It would be kind of unusual that we don't go back and try to at least retest those gaps before trying to move higher. And the farther and farther we get away from it, it's the less likely that we will come back. But at the end of the day, that's still a level that maybe some shorts are looking to try to target if we do see a little bit of a fall off in action. Now, when you're kind of looking at the internals, the liquidity is definitely in the market. If you're looking at the book depth for the E-mini S&P 500 futures, looks really healthy, around 45 to 50 contracts in the bid and ask on average, which is actually really good. But the volume for today is actually really light. And this is going to be one of the lighter volume days if we keep up at this particular pace that we'll have probably over the last 3 or even 4 weeks here, just based on the S&P 500 total composite volume. So that also kind of leads a little bit more validity to the fact that we are seeing compression in these markets. You don't really like to see that. As a bull, you would want to continue to see us move higher with price. But at the end of the day, if we're stalling out and the bears are not able to knock us down, I still think that gives the bulls the edge for us to potentially reach all-time highs here in the hopefully next couple of weeks.
I know, I was speaking to Kevin Hanks earlier in the show, and he called today listless from the SIBO floor. And, do you think we'll continue to see much of the same, as June generally tends to be a quieter month? Or do you think things like the jobs report coming out on Friday are going to have us see the volume increase back up?
Yeah, the jobs report on Friday should actually be a key catalyst for volume. And actually, if you look at the non-farm payroll reports on a month-over-month basis, they actually do create really good floors of support levels or resistance levels in the market. So that will be actually a very key driver. And I think the market is also kind of waiting for that number to come out, especially because of the ADP report that came in a little bit light here today. And you're also seeing kind of this reaction in the yield market that I think is very key. Obviously, we've been focusing on yields moving higher over the last couple of weeks because the debt issuance and potentially foreign buyers backing away. It just does not seem like the case that we are seeing a lot of that follow through, right? We are still seeing some buyers stepping in when we have risk off data hitting the market. And today was one of those stagflationary type of scares that we got with PMIs as well as the ADP report. And if you actually look at the comparison between the S&P 500 and the 10-year 3-month treasury yield spread, I actually like looking at this because there's a really strong correlation between the two. And anytime that they diverge, it's something that I always, it's a little bit of a radar item for me. And we are seeing a divergence today where the S&P 500 is moving higher, but over the last couple of days, that 10-year, 3-month spread is actually moving a little bit lower, getting close to that zero line or going into that inversion level. We're about 1.25 basis point away from that. So once again, on the surface, the price action looks good. Volume, for the most part, is a little bit light. But when you're looking kind of under the hood, if we get a confirmation of a lackluster job market on Friday, like a really bad print, that would probably be the biggest thing on the radar for the bears to try to step into this market and take some profits.
And I want to make a big pivot here, Kevin, as I look through your charts that you sent over. I see that you've been keeping an eye on Coreweave. You know, they had a colossal May, up 170% in May. I'm looking at them right now. They're up 7.5% just on the day. What are your takeaways?
Yeah, this is a stock that continues to get squeezed. And this is an interesting one here. Every day we are seeing new strikes being added to pretty much all of the expirations. But if you look at this week and the next 2 weeks, those are the really active expirations that are being targeted. So the new strikes are coming out. You're seeing a large amount of buyers stepping in, and let's say the 200 strike level, which is actually the most actively traded one today that I've seen as far as aggressive buying activity. Once that occurs, you have dealers actually buying up the stock. It's still relatively a very low float stock, very hard to borrow. So this is still a gamma squeeze in the making here. And it's just remarkable that you can continue to see new strikes kind of hitting the market. Buyers continue to step in. And until that stops, this trend can continue. But when it does stop, Marley, as you have seen in the past and all of us have seen, the reaction to the downside could get fairly aggressive. It just doesn't seem like it's over yet. So this one's definitely on the radar. Interesting for intraday swings, but very, very risky. And you got to go into the trades knowing that you can lose all of your premium if you're going long calls or going long puts.
Well, we'll keep an eye on this one, Kevin. I'm sure it's not the last time that we'll take a look at Coreweave together during Options Corner.